Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I have a bit of good news. I am putting out my annual basic investing and personal finance Zoom seminars. So go and take a look at my fresh new website, canadianmoneytalk.ca. Go look at the education tab, and there you can sign up for the 4 seminars. So they all are at 6 p.m. Pacific. And part one is definitions, risks, asset types, dollar cost averaging. That's October 18th, 2022. Part two is investing strategies and taxation. So that's going to have some advanced tidbits. And that is October 20th, 2022. Part three is going to be mortgages, credit score, insurance, including universal life insurance, um, financial independence, some scams and how to avoid them, and alternative investments. And finally, what you can expect from a financial advisor. So that's October 25th, 2022. And lastly will be part four, which will be a Q&A, October 27th. So these are all 6 p.m. Please go to canadianmoneytalk.ca, go to the education tab, and you can register for those seminars. So now on to my thoughts on market happenings for the week ending October 7th, 2022. Looking at the market indexes for the week, the TSX, S&P 500, NASDAQ, Dow Jones, and Russell 2000 are all up, mostly on the Monday and the Tuesday large gains that we had. But then the markets sell off later on in the week, punctuated by Friday's sell-off based on the good jobs report from the US, which I will mention in a second. Oil was up double digits and gold was up 2% for the week. The ISM Manufacturing Index numbers and JOLTS report, which is jobs opening and labor turnover survey for the US in September, indicated that the economic activity is slowing in the US, including employment orders, and this is leading to the markets thinking that inflation will ease and central banks will stop raising rates since the previous hikes have helped. So these two reports were released early on in the week, and that sparked the upwards run at the start of the week for the stock market. Later on in the week, however, things turned a little ugly. So Canada had the latest jobs data from September on Friday, and a combination of wage growth, unemployment data, and inflation are setting the tone for central bankers to remain steadfast in hiking rates and causing a recession. The Canadian unemployment went to 5.2%, lower than expected, and also lower than the previous month's 5.4%. This caused the stock market to sell off with an expectation of further rate hikes by the Bank of Canada. The lower unemployment rate was due in part because of workers leaving the workforce. The number of hours worked dropped as well, which is a classic sign of a weaker economy. Wage inflation is still at 5%, but is decreasing slowly. Similarly, the US weekly jobless claims climbed 29,000 to 219,000 on Thursday, and continuing claims rose 15,000 to 1.361 million. However, on Friday, the US unemployment numbers came down to 3.5%, meaning future increasing wages, growing economy, and therefore continuing of interest rate hikes in the US. The good news led to a sell-off on Friday in the US. It may be better to get into the recession sooner rather than later and get things over with, in my personal opinion, and have the Fed and the Canadian Central Bank stop raising rates. The central bank's quote-unquote pivot to stopping the raises or even lowering interest rates seems nowhere in sight so far. A recession seems inevitable on both sides of the border. but due to the strong job markets, the recession is still looking pretty shallow. We had an OPEC meeting this past week, and there is a review of oil inventories, Russian oil being taken off the market, and the sanctions possibly working against Russia or not. So OPEC Plus announced Wednesday that it will cut oil production by 2 million barrels a day, defying US requests that it instead boosts output to ease soaring global inflation. It's the deepest production cut by the oil cartel, which includes US allies such as Saudi Arabia and the United Arab Emirates, as well as Russia, since the start of the pandemic in 2020. OPEC Plus, which accounts for more than 40% of global oil production, is hoping to avoid a further drop in oil prices as economic slowdowns in the US, Europe, and China trim demand. This 2 million barrels per day is a major cut, may push oil back up to where it was earlier this year in mid June. We are in a systemic oil deficit, although the actual cut will likely be far less than the 2 million barrels per day. It looks like people will be getting a lot of steeply marked down Nike gear for holiday gifts this year. The sneaker and sporting goods company said in its earnings report Thursday, September 29th, that it's overwhelmed with products for multiple seasons because of supply chain problems. Some shipments showed up after taking too long, Nike said, while the company is also getting product for the holiday shopping season, which it ordered early to hedge against shipping delays. Overall, the company's inventory jumped 44% in the prior quarter and by 65% in North America, its largest market. So that's left Nike with no choice but to quote unquote aggressively liquidate big chunks of its inventory, said CFO Matthew Friend. Nike is an indicator for other retailers and their high inventory levels due to supply chain issues. Credit Suisse, the Swiss bank, ran into financial instability issues and was facing a quote critical moment unquote. Its shares fell this past week. This is not a Lehman Brothers moment from 2008 by any means, however. The US dollar is having its best run in 20 years, with US interest rates rising rapidly and investors worried about a global economic slowdown. Investors have moved into US currency in search of yield and a safe haven. The dollar rose 8.6% during the third quarter. Meanwhile, the euro fell 6.8% against the dollar and the yen fell 15.2%. The strengthening of the US dollar will likely have negative effect on third quarter earnings. In particular, large multinational tech companies will see a headwind as sizable chunks of their sales come from outside the United States. That's because as the value of the dollar rises, it makes US produced goods more expensive outside the country. Conversely, Canadian companies with earnings in the US are benefiting. I wanted to mention an even more fundamental reason for the market correction we have been seeing. So far, the main driver of the market correction has been a sharp drop in valuation multiples provoked by the rise in interest rates and the fear of subsequent recession. But earnings estimates have held up well. What would make things much worse would be a downward revision of earnings estimates in major companies. There have been a number of significant profit warnings recently, such as those from Snap, Zoom Video Communications, or Peloton Interactive, which were the poster children of the pandemic world, but so far those seem more idiosyncratic than revealing broader issues. Let's hope big, usually steadfast companies don't have the same issues. Turning to real estate, the average home price in Toronto dropped 1.2% to 1.1 million in September. Looking ahead to Q3 earnings season, which starts next week for US companies, for the quarter ending in September, there have been a number of few revenue and profit warnings and downgrades, such as recently in the semiconductor space, which may cause profit margins to come down, but overall things seem to be holding up. costs, the company's pay may be coming down too, which may balance things out. Today, note that if we do get into a recession, profits typically come down 22% in an average recession and 30% in a deep recession. Turning to next week, we have a few company reports. Thursday is the Taiwan Semiconductors, and Friday is United Health and US banks like JP Morgan, Wells Fargo, Citigroup, PNC Financial, and US Bank Corp starting off the earnings season. For economic events next week, Wednesday is the Producer Price Index information indicating inflation and US Fed meeting minutes. Thursday is US CPI numbers to indicate how the US inflation is moving. And we have International Monetary Fund meetings being held all next week. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.